Good afternoon and welcome to today's Premium Account short form market update. Any individual reading should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals, and I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The format for today's presentation is a short form, so it's a quick summary of the global macro outlook. We look at our preferred buy and sell transactions, price target and valuation, and conclude with a summary of our asset allocation and the short-term Australian market outlook. The Investor Signals Premium Account service is based on a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns, and we're focused around effective ownership of stocks approaching their ex-dividend dates, and we look to generate above average cash flow through the effective ownership of stocks and through their dividends and the call premium, while still providing the opportunity for some capital growth, and the portfolio is managed under a strict investment mandate. If you'd like to know more information about the Investor Signals Premium Account service, please contact me, Leon Hine, info@investorsignals.com. Moving straight into presentation today, the XJO. So a quick summary of the macro valuations impacting equities. If you look at the 2013 earnings in the S&P 500, what we saw during the course of 2013 up until the end of the December quarter was S&P 500 earnings growing at approximately 8%. The interesting thing though was that the December quarter delivered roughly 10% earnings growth on the prior corresponding period. So we actually saw an acceleration on average of S&P 500 earnings into that December quarter. We're only now just ready to see earnings season commence for the US for the March quarter, and that'll provide a little bit of an insight as to whether that same growth rate is carried forward into March or not. When you take into consideration that the December quarter was accelerating, and the market currently in the US is priced in on a forward outlook about 8% earnings growth for the S&P 500, you probably have to form a view that equities are still, whilst at the top end of their historical PE range, are still sitting in reasonably fair valuation, especially on a relative basis to where bonds are. But the probability of equity markets moving substantially higher from here, I think, diminishes, and we're probably more likely to see a period of consolidation with maybe some further valuation expansions in the back half of this year if we see better GDP data come through from Europe, and if we see a stabilisation in the emerging markets, and in particular better stability in the data flow coming through from China. So what that means for our market from an index standpoint, I've always sort of been of the view that we'll probably bounce between 52 and 5,600. I'd expect to see us to run into resistance up at 5,600 and possibly pull back, and I think that'll sort of consolidate the range over the months ahead, and as I mentioned, maybe in the back half of the year we could start to see the XJO trade a little bit higher again. So let's look at it from an individual stock perspective. Some of the names that we have been active in and we like in portfolios at the moment. So we've been buyers of AGK on this recent pullback, trying to sell calls up at around the $16.50 to somewhere north of $16. And the argument here is that for AGK up at $16, the yield presses down almost below 4%. Generally speaking, I don't think the stocks can sustain a compressed dividend yield much below 4. So fair valuation for AGK is probably somewhere around $15.50. So any push higher, we take that opportunity to sell the covered call. One of the stocks that we like, and it's pulled back a little at the moment, is Amcor. Currently at $10.20, the stock's on about a 4.5% dividend yield and about 15 times earnings. The market's looking for pretty bullish earnings numbers into 2015. Even if we were to put that, ratchet that back a little and say that the company only delivered somewhere between 8 to 10% earnings growth into 2015, the stock then goes to a 5% dividend yield and trades on about a 13.5% times earnings. So at around this $10 level, I think it could potentially represent a reasonable buying opportunity. I think the downside risks are limited, so we're happy with capital that's available to take another look at Amcor at this $10 level, let it rally back up to around $10.50, $10.60, and then try to sell calls up at around the $11 range. I think that represents a reasonable risk return in the months ahead. The other name that we quite like at the moment after the recent sell-off is the ASX. Down here at around 35.50, the stock trades on about a 5%, little over a 5% dividend yield. It trades about 17.5 times current earnings. If they were to grow earnings at around 5 to 8% in the 12 months ahead, the yield goes up to a 5.5% yield. The PE drops down around 16 times earnings. So I think, again, it's one of those names that the downside risk should be pretty limited, but through owning the stock on this pullback, selling the covered calls, collecting the dividend, we're driving around 10 to 12% cash flow out of ASX. And the added sort of safety net here for the ASX is that there's a reasonable probability that we'll see some sort of corporate action whether it's in the next months or across the next year or two. But I think what that expectation does is underpin any depth to a sell-off in the ASX. Within the resource space, we've continued to have exposure to BHP. The stock trades at about 3.5% dividend yield, about 13 times earnings at the moment. I still maintain up here at around $38 is the opportunity to sell the $39 call. If we can collect roughly $1 for that, it's giving us effective exit price up at around $40. I think that caps probably the upside in BHP. From a picture some months back where the market was looking for around 10% earnings growth into 2014, our view on these resource names is we've probably got a fairly flat earnings growth environment ahead of us. BXB, another name that I like from a defensive perspective. I think the downside risks are limited, albeit that the stock is expensive, trading at about 18 times earnings on a 3.5% dividend yield. But an opportunity to buy Brambles down at around $9.25 or $9, and again sell calls up at around $10. I think that's roughly the range there for Brambles. And we continue to sort of look at that. Coca-Cola's had a little bit of a bounce after sort of selling off down into this sort of $10.90 range, and we're starting to see it rally back up. Ultimately, I think by June we'll see Coca-Cola back up to around $12. At $12, the stock's pretty much trading on a 5% dividend yield. I don't think it'll support short-term too much more movement higher than that, but I think gradually over the next year or two we'll start to see better discipline out of the company around cost control, and ultimately we sort of see Coca-Cola trading back up into our sort of $13 price target over the next 12 to 24 months. But in the meantime, we've collected good premium from selling the 1240 calls in June. They'll wind off. Hopefully we start to see Coca-Cola trading back up towards 12, and then we can resell those calls again to keep that cash flow, again, around 10-12% cash flow from the call premium and the dividends. The other name that we've been reasonably active in is GPT, so we've taken advantage of picking up GPT on this recent pullback. As the stock rallies back up to these levels, I think it's starting to get to a point where it's worth looking at selling covered calls. The stock's yielding around 5.5% at current levels. Another one that we have in portfolios is IPL. So I think here at around this $3 level starts to look reasonably expensive short term, about 3.5% dividend yield, trading about 14 times earnings. So again, we want to look to cap the upside there on IPL and drive the income through the dividend and the call premium. Lendlease, we've been aggressive buyers of Lendlease from lower levels. Up here the stock starts to look a little expensive, but if you were to put that in the context of where do we see earnings over the next, say, 2 to 3 years, I think Lendlease, the industry dynamics are there but to support Lendlease delivering sort of 8 to 12% earnings growth. That puts the stock on a dividend yield on current valuations around on 2014 earnings of around 3%, and trading up towards a 14 times earnings. I just think it's starting to get a little bit expensive up here, so again we start to look to sell covered calls over Lendlease after owning that at lower levels. Within the banking space, we continue to like ANZ and NAB, which come into their ex-dividend period. We continue to like Westpac, which I'll have a look at a little bit more. Origin's another name that we've been active in and through selling the covered calls. So we like the stock at lower levels at around $15. It starts to get a little bit expensive. It's on 3.5% dividend yield and about 20 times earnings. So I don't think there's the impetus for Origin to trade too much higher short term. So again, one of those names we're selling the covered calls, collecting the dividend, driving about 10 or 12% cash flow out of Origin. Stocklands we've been active in, so some of these property names we've picked up on the recent pullback. So Stocklands pays their dividend in June, and I imagine the stock price will be well supported coming into sort of that May-June period. As the stock pushes up to around 390, we look to sell the covered calls up at around this 410 level and collect the upcoming dividends, so a combination of capital growth there and about 10 to 12% cash flow out of Stockland. Sonic Healthcare, after the recent pullback that it had, we just started picking up the small amount of Sonic Health around this 1750 level. The stock is expensive, and to put that into context, trading about 18 times earnings on under a 4% dividend yield, but they should deliver 10% earnings growth. And where that becomes relevant is if they can do that in 2015 and then again in 2016, the dividend yield's pushing up to around 5%, the PE's getting down to around 15 times. So you can sort of start to understand the picture that we're in, where the valuations are higher at the moment. In certain names where there's certainty of earnings growth, there still warrants paying a reasonably high PE, selling the covered call, having a view that they move sideways for 6 months, but then ultimately giving them room for further capital growth towards the back half of this year. Telstra, so again, one of these names that have pulled back a little, so we've been recent buyers of it at around $5. I think as it pushes up into the August dividend, there we'll get an opportunity to sell covered calls up around the 525 level, so again 10-12% cash flow and some capital growth. And then finally in today's recording, just to have a look at sort of Westpac out of the banks. They're all similar story, but we own Westpac at lower levels. We've sold the covered calls up at around the 35.50 level. They're European style, so we collect the upcoming May dividend, and it puts some valuations around these banks now. So at these levels, Westpac's getting down to a low 5% dividend yields, trading a good 15 times earnings, so it's expensive. We're probably only looking for about 5 to 8% earnings growth in the banking stocks. So I think that covered call level in the banks probably again complements the 5% dividend yield, drives the cash flow up to around 10 to 12%, and in the case of Westpac, we own it at lower levels, so some good capital growth there if we were to deliver it under the covered call. Westfield, so this again was a name that I've spoken about a number of times at around this $10 level here. It's good value. I can see Westfield trading back up to around $11.50. I think that's the cap for Westfield at that level. It'll start to run into resistance. That'll put it back on about a 4% dividend yield. So definitely looking to sell covered calls over Westfield if it trades back up above $11. Wesfarmers, so we've been active buyers of Wesfarmers in the last few days. We've picked up a fair amount of shares here under this $42 level, predominantly around sort of that $41.80 level, and up at around $43, $43.50 would take the opportunity to sell the covered calls at around $44.50. And again, giving a good combination of 10 to 12% cash flow and some capital growth there. And then finally in today's recording, just to look at the last two stocks, Woodside Petroleum. So one of those names that we own at lower levels. We've been letting it rally up to around this $39. We're selling the $39 to $40 calls there, taking the stock from sort of traditionally yielding around 6% at current valuations up to around 12% cash flow out of that call premium. I think it's probably likely to bump sideways around this $39, $40 level, and we'll get an opportunity to either deliver the stock and lock in the gains or continue to sell the covered calls. And then finally, the other property play that we've been active in is Westfield Retail. So we predominantly own this at around this $3 level. At around $3.15, take the opportunity to sell the $3.20 to $3.30 covered calls, and I think that caps the upside at that level. That'll put Westfield Retail on a yield of around 5.5%, and after traditionally trading around 6.5% yield, I think it'll run into resistance up at around that $3.20 level. And just to conclude today with a quick look at AG, well, we've covered AGK, so we can leave today's recording there. Thank you for listening in, and I look forward to speaking again next week.